So few people actually understand what is going on in the housing market. It may not be what you think it is, and it certainly isn't the headlines that you're hearing from mainstream media that is spouting out there that we have a housing shortage, which is absolute nonsense. Let's dig into what you actually need to know as a buyer, seller, investor in real estate sales, because it could not be further from the truth of what is actually being put out here. This situation that we're in right now for the housing market is very bad, and it's getting worse. Here's one indicator that's a signal that really tells the entire story. Estimated percent of 30-year-olds who are both married and homeowners has dropped from 1950 from 54% all the way down today to 12%. So what is happening is an affordability crisis. People are no longer making enough money to buy a home or even a starter home, which I'm going to be talking about new construction and how builders built mid-level luxury instead of starter homes for the last few years, causing there to be a massive divide in what the next generation can actually afford, and is keeping them renters and putting off this people getting married and buying their first house. It's getting worse every year, and honestly, it could get even worse moving forward. So when we look at the data, and this comes from the National Association of Home Builders, basically what they say is that 80% of people really can't afford the median price home in today's market. The other 20% that could buy pretty much already bought when the interest rates were low. This comes from the National Association of Home Builders and basically just explains the highest price home that people can afford according to the data in 2026 in U.S. households millions. So you can see that there's just a certain percentage of people that can even afford more than $400,000, which here in Jacksonville, Florida, around $400,000 is the median price point. And so you have about 80% of people that literally cannot afford a higher priced home. But there's not that many homes for sale that are in good condition or are in areas that are highly desirable that are underneath the 400,000 price point. Often they're on the outskirts of town, they require long commutes, and sometimes they're even shoddy construction by the home builders where they just slapped them up during 2020 to 2023 and just sold them at record prices. Now those people who bought during those bubble years are paying the price because prices are coming down. I'm going to show you the data of what is happening to those folks who are now trapped in those houses and bought at those peak prices. And right now, because we have such an affordability crisis, there's a massive disconnect between sellers and buyers. So obviously from 2020 to 2023, we had this massive run of so many more buyers than sellers. It was impossible to get an offer. There's multiple offers on all the houses. And then when the Fed started raising rates in March of 2022, and basically it showed up in the numbers we saw at the end of the year around October, November, where you really started to see the divide between the buyers and the sellers. It had a year adjustment period, and now because the rates have remained high, mortgage rates have remained high, you now have more sellers than buyers because buyers can no longer afford the payment. They get absolute payment shock when they go in and do their mortgage documents and they get their estimate back and they see that the price of the monthly payment is something that it makes no sense to do when they could rent a house for often $1,000 to $1,500 less. So we expect this divide to continue going forward, where there's going to be less buyers and probably more sellers. A lot of this drop off in the sellers right here is because we see a lot of what I call rage delisting or rage quitting. Sellers list their house on the market. They can't get the price they want. They need the money in their home to be able to move to their next home. And so they basically get angry at their real estate agent, take their house off of the market, blame them for not selling versus just reducing the price. And now you have this period of time where you have all these pent-up demand from the sellers. It just hasn't hit the market because they took it off of the market. And we're seeing that across the board. I can show you the expired data. I can show you the withdrawn data. It is skyrocketing across the board. And what is interesting is this is happening during busy season. And of course, the big story here in the Sunbelt area are these overbuilt communities that just have tons of new homes and they just continue to build. And what this is causing is putting a lot of pricing pressure on new home builds who have traditionally been using financial incentives, such as buying down your mortgage interest rate in the case of $50,000, which is incredible. all the way to get you down from a 6.5 to a 3% rate. This is a huge warning sign on the market. Obviously, if you have to basically bribe somebody with a interest rate to get them into the house is obviously overpriced. So remember, if you're a buyer, you need to be really careful on these new construction homes. If you want to buy new construction, you can reach out to me. I'm building a database of new construction communities around Florida. You can check it out at movewithmomentum.com. You can search by neighborhood and give us some feedback. You can always email me. But if you're looking for a top real estate agent that can help you, reach out to me. We have connections across Florida, across the country. I'm able to get you in touch with a top agent that'll actually help you in your specific market. But you can see that existing home prices have just skyrocketed over the last decade, and now new homes also went up with it, but now they're starting to correct. And this is another big warning for housing. We've never really had a period of time that's been sustained where new homes are actually selling for less than existing homes. And the new homes are also stacking up. I know there's a lot of people that reach out to me for reporters or whatnot saying, hey, I'm not seeing this. Where are you seeing this? I can show you on MLS where we see pockets of distress, because we can see the cumulative days on market for these builders. A lot of these builders only put one or two of their active listings up on the MLS. The rest of them are hidden. So we have all this shadow inventory that isn't actually on the market, but you can see the completed spec homes is starting to drift a little bit upward from the 2020 time period. But what's interesting is that under construction has skyrocketed, and the houses not started yet, but already permitted, have skyrocketed. So they have the ability to build a ton of real estate, but that's not what's actually happening. So how could you have a housing shortage and at the same time not build those product to sell it to people? It's because we're not in a shortage. We have a housing mismatch, and the prices no longer make sense for the consumer because we're in an affordability crisis. It's a totally different issue than what a traditional shortage is, and that's why the media is lying to you. They want you to think it's a shortage so they have emotional response to go out there and buy a house like it's going out of style. That's just not the case. This chart completely disproves that fact. They're not developing these houses. They're sitting on them because they can't sell them, and they're already overbuilt. And this is what's happening. How can you have a shortage and then have your new construction home drop 25% in 4 years, right? This is from Lennar, comes out with public data that they have to report through their filings. And obviously we saw this massive run up from 400 to 500,000 within just a few years. And now we're all the way back down from an incentive level to worse than basically the 2019 timeframe. So we're back, especially on new construction in specific areas. And by the way, if you're looking to buy at the end of this year, is a great time to negotiate with the builders. A lot of their year ends actually end in October and November, and they want to make those sales for their numbers to push it to the next level to look good to investors. So if you want to reach out for strategies going into the next year, definitely email me. It's jon@movewithmomentum.com. Go to our website, movewithmomentum.com, and look at the data that we have there. But this is a huge story that isn't talked about enough. And of course, this also includes the net of incentives. So about half of this, or even more, is just the fact that they're buying down the mortgage interest rates. They're getting forward commitments from lenders that basically get a pool of money that they can basically sell to you during a specific period of time. So they need to originate these mortgages. They need to sell their houses. And the last thing they want to do is reduce the price of the home, because then they'd have to reduce the price of all the homes in the community. And that crushes the appraisals when they go through, and they don't want that to happen. And that's why they leave price to the last thing that they move. But obviously, if you're not moving enough inventory, then it can really backfire quickly. Right now, you see 2026, 51,000 sales in May. It's busy season. That is incredible. Look at what happened all the way back in 2008. I mean, we're only 2,000 away. We are going into a really soft, busy season for new construction, despite all of the incentives that are happening out there in the marketplace. And again, this is another red flag that the media just won't talk to you about, won't tell you about. And the builders, honestly, this is comes out from Parcel, where home builders have exhausted options and are now cutting prices. So they've stopped doing the incentives, or they keep doing the incentives, and now they're cutting prices across the board. You can see by metro and the type of builder that is out there. So again, I look at Jacksonville, Florida, and down 5.5% on Pulte homes. I can tell you going into that, I know people who are negotiating off $100,000, $150,000 off of homes, depending on what the price point is and where it is. And there's a lot of stuff on the outskirts and pockets where if it sit for even a year, they are going to slash their prices to get the liquidity and get out of that position and sell it. So this is a great thing for buyers. We badly need a correction here in Jacksonville. We're already in a correction. We're headed potentially for a crash. It won't happen overnight. I know a lot of people think, okay, crashes happen within 1 to 5 years. I do not see that happening. I think we're going to see a steady affordability crisis that could last up to a decade, where prices just go stagnant or down until wages keep up. And we don't know what's going to happen with wages, but if the job market cracks, it's going to crack this housing market wide open, because it is like sitting up on stilts right now. You can already tell because of the way that the builders are acting. And of course, existing home prices have also skyrocketed, but now they're leveling off, and we are actually likely to see, even on a national basis, a decrease in home prices this year, which is a great thing to see for the buyers. They're finally getting some breathing room, which is much needed. And by the way, it's not just single family homes and single family rentals. It's also multifamily. Here in the Sun Belt, there's so much multifamily, luxury multifamily that has been built that is just, it's swamped the market. And you can see now that these multifamily that finish, they have to turn their bridge financing into permanent debt. And when they try to rotate it, they're not occupied enough. So what we're starting to see is multifamily serious delinquency rate is starting to move up and get worse than the great financial crisis already. And we're not even in a crisis right now. Everything's near all-time highs. So this is something you really need to be thinking about if you're a multifamily investor, if you're a single family investor. We're seeing rents come down about 10 to 20% as well. That's going to crush this asset class as an investment. And meanwhile, the consumer sentiment is near record lows. The Americans are feeling bad. You can tell that the Wall Street is on fire, but Main Street is completely disconnected from Wall Street. And it's only the top 10% of wealth holders that are really benefiting from this economy. The remainder of people who don't own assets are honestly being left behind, and the next generation is getting really pissed off about this. And of course, the consumer sentiment is dropping, and there's a lot of concerns on the horizon, such as credit card debt. You can see that the percent balance of 90 days plus delinquent of credit cards, even without a crisis, this is what's so crazy, without job loss, we're already seeing this level of debt. So the consumers are maxed out. You're seeing the delinquencies already without the job loss. The banks have overextended themselves, and this could get really ugly over the next couple of years as this plays out, because all of this debt will have to be forgiven. So the banks will take a hit, and the consumers will take a hit and have a hard time getting access to credit. Or we can't continue this debt train forever. It's just unsustainable. But we can't tell you what the time frame is for this credit bubble to pop, but it is at a point where it's a bubble, and that's the most important thing to understand. We know this is true because, even in our market, when we see buyers out there, they're often getting gifts from their family members to be able to afford a house. 6 in 10 parents are now helping their kids buy homes. A new survey finds from Veterans United Home Loans, which is incredible. They're getting $25,000 to $100,000 more as gifts to be able to purchase a house. Well, traditionally, young people are supposed to go to work to help their parents live. And now we're actually seeing the parents who had this massive wave of appreciation of their houses and stock portfolios turn around and give their kids a hand up, which I think is great. Honestly, you're passing down the generational wealth to your kids, but you're also doing it at a time where you're seeing record high prices that likely a lot of that equity will evaporate in the next few years if they have to buy and sell. I really am a big proponent of your time frame. If you are planning to stay for 10 to 15 years in a house, go buy the house for sure. But if you're planning to sell in 3 to 4 years or even less, I don't think it's a good time to sell. In most cases, it's way better to just rent your house. We see way too many people that try to buy and sell within 2 years. It's not like it was from 20 to 2022. It's a completely different market now than it was then. And of course, there's a generational divide where basically the millennials and younger generations are just getting really frustrated. All of the wealth is kind of just aggregating towards these older generations, which makes sense. They've had more time to build their wealth, and there's nothing wrong with wealth building. But the problem with it right now is it's accelerated so fast that the next generation feels like it's impossible to get wealth, to buy a house, to get married, and to do traditional big life events. So they're postponing these major life events because they feel that their financial situation is so slated against them that there's no way to get ahead. Again, if you did not own assets, your parents didn't own assets, assets, you've pretty much been left behind if you're just playing the wage game. And the affordability crisis is already worse than the 2006 peak. And this is, again, why the next generation feels so frustrated, is that we're feeling this even with a full employment market. I can't imagine how people will feel when there's going to be massive job loss. And this is one of the charts that is controversial because it came out from the National Association of Realtors, which uses mail to be able to do their surveys. But it has been consistent over the years, and it turns out the median age of all home buyers has moved from about 28 years old all the way up to 60 or 58 years old as well, which is crazy. So not only people putting time off, they're just the buyer age is just completely older. What a lot of people think is, it's those people who bought when they were 40 years old, they had their house for 20 years and now they're selling it when they're 60 and either downsizing and moving. And those are the people out there who are actually transacting right now, because those are the only people who have the equity to be able to make those type of moves. But the tables have turned and things are getting better for buyers. Right now, we're seeing this power dynamic shift where 46% of home sellers are giving concessions to buyers. This is up from the prior years. This is great. The buyers are being able to actually go in and negotiate. Homes are sitting longer. And I think this will be a trend that we continue to see going in through the end of the year. Real estate, as you know, is very cyclical. So prices are going to likely come down from now until the end of the year. After August, when school starts, we see prices and volume of transactions drop significantly. And when we're in the middle of busy season right now, and the numbers are not looking great. So we are optimistic that, the buyers will be able to get some help moving forward. And just to summarize this all up, it's really simple. 2021, you could buy a $500,000 house at a 3% rate and get a $1,686 payment. Now, 2025, 2026, same house at a 6.5% rate. It's like almost $1,000 more. And this is what is crushing the next generation, saying, I can't afford this. And by the way, property taxes are higher, insurance is higher. Basically, every other input is also higher, what that feeds into the payment, and people can't afford to buy these type of homes. So what they're doing is they're basically just staying as renters, and demand is dropping to near record lows, just as bad as the great financial crisis. And of course, that shows up in the numbers. This is the 1 year change in metro level home prices between May 2025 and May 2026. You can see that the areas that had the most speculation during 2020 to 2022 are now the areas that are getting hit the hardest, because mortgage rates are sticking high. Even though we have oil come down $30 a barrel, and we have mortgage rates basically stay high, even though we see the 10-year treasury disconnect. So we're seeing investors price mortgages as a more risky of an asset right now, because we are seeing home prices decline. So if you're in the Sunbelt area, look, you are now having the power. Prices are going down. We expect prices in the Sunbelt areas, especially around new construction, to continue to decline, especially if there's more and more new construction that is around the corner. This is, again, great for buyers. And we're going to have to see what happens with the migration numbers, which is interesting. We saw, a massive amount of people from the Northeast and out West move to areas like Florida or other, no income tax states and business friendly from 2020 to 2022, and we saw that massive migration. It's basically halted because of this affordability crisis. People are now saying, look, Florida and Texas are too expensive. I'm actually going to go move out to the Midwest. And we're seeing people move out to the Midwest to try to find more affordable housing and a better way to live and better jobs and things like that. And so that could really impact the Florida and Texas market. So we're going to have to watch what happens with the migration patterns very closely, because the last round of numbers did not look very good. And the other thing I want to comment on, look, I don't like to get into politics. I just like to look at the policies. But one of the dumbest policies I've seen is this, ban on single family rental aggregators. Because the thing is, you're doing it at the wrong time. If you're going to do that, you do it in 2020 when you have rates at zero and they're buying. Since 2023, basically a lot of these single family rental aggregators have actually been net sellers, not net buyers. They're also building entire build to rent communities, which is adding to the rental supply that we badly need to drive down rent. So this is just one of the dumbest policies I've ever seen out there. It's very sad that we have all these people that claim they're housing gurus in the White House and in the administration, and they just don't know anything about real estate. They're focused on this 7.2% of units, which are the institutional buyers, but the majority of the buyers that drove up the prices are actually the mom and pops and the small landlords that are under 100 units that represent, basically 92% of all of the transactions that happen. So instead of focusing on the stuff that matters, if they were actually going to do anything, which I don't think they should do anything, I think they should let the market be free. The whole reason we're in this mess is because the government keeps stepping in and manipulating interest rates, manipulating policy that drives prices to unsustainable levels and creates bubbles. If we just let the market be free and stop buying these mortgage-backed securities, we would already have a normalized market and would not be going into these bubbles. But again, the government just can't seem to find a way to just stick its nose out of things. It just has to get into every little detail of our lives and try to control everything that happens. And I don't think this is a good policy from the institutions. I want the institutions to build more real estate so it drives down rental prices. And I think banning them now is just like pouring water on a house that already burned down. It just makes no sense to do it at this point in the market cycle. But that's my opinion on that. I think it's a really dumb policy. I'd love to know what you think. Comment below, let me know what you're thinking. But ultimately, nobody knows what's happening next. I see that there's potential for rate hikes going into the end of the year because of inflation spiking its head up. But I'd love to hear from you. Where are you and what are you seeing on the ground? What do you think will happen next in the housing market? And what did you learn from this video that you didn't know going into it? I'd love to hear from you. Every time you comment, it gets me a ton of motivation. Bring you more information for the next video. During this summer, I'm doing one video per week that'll come out on a Wednesday or Thursday. Once school starts, I'll give you 2 videos a week. As always, you can find me online on Substack, johnbrooks.substack.com, or go to my website, movewithmomentum.com, and start looking for real estate in Florida. Thank you so much for watching, and I'll see you next week.